One more, please. 6 minutes.
Thank you, Mr. Nava. I'd like to come back to this idea of minimum harmonisation that you talked about in your opening statement. And you said that this provided for the minimum requirements for prudential supervision being enacted in each member state. So, to your knowledge, did any country enact less than the minimum requirements or attempt to enact less than the minimum rules?
No, they cannot go less. They cannot go below, if the expression exists. So there is a minimum level of rules. You cannot go below. What the countries can do is to go above. So the issue is not going below, the issue is going above. Now, as I said, there has been a global thinking, a global movement out of giving little guidance and out of giving only principle-based to a more rule-based system where we tend to say much more of what the countries could do or should do. So, but there is no issue of possibly going below the rules which have been set.
Well, to your knowledge, did anyone back, at the beginning of that decade and the years leading up to 2006, did anyone go above when they were transposing these directives? Did they decide to go further than the minimum recommendation?
If they wanted, they could have done.
Are you aware that anyone did, though? I mean, sure, the Commission follows this up.
There are some countries who, when implementing, but especially when supervising, for example, even in absence of precise guidance for supervision, they went for more intrusive practices. Essentially, when it comes to supervision, and here I'm really banalizing, but then to give you the idea, there are two types of supervision. One supervision, let's say, was a more intrusive supervision, where you had supervisors in the bank physically going residential in the bank and checking the numbers. In other countries where they had a more hands-off supervision and less day by day. These were two schools. Then, of course, again, I'm banalizing, there are intermediate positions, okay? But for us to be clear, these were two schools of supervision that we saw progressing in Europe in different countries, and then it may be one of the reasons why we came more recently with much more guided rules, with much more guidance of what the supervisors can and should do in particular circumstances.
And have you found, as you watched this happening throughout the 2000s, into the 2006 and then the crisis from 2008, did you find a correlation between those countries that had gone further than the minimum and the success or the robustness of their banking system in the crisis?
Supervision certainly helps to contain risks, and supervision, more intrusive supervision, which may mean or certainly means better knowledge of the risk management of the banks, so better knowledge of the banks, of the internal measures that the bank itself takes. This has helped, and I think one can look as a correlation. Then, of course, the crisis was general, went over in Europe, but it's clear that it has hit some countries more than others.
And when we then come to 2006 and the Capital Requirements Directive, you say in your opening statement that had these powers been used to the full extent, a number of major difficulties could have been prevented. So are you saying, and you're talking about in general about the countries, and you're not talking about one particular country, but are you saying that the directive wasn't being implemented properly, or it wasn't being followed properly?
No. I'm saying that what I'm saying is that the directives were transposed, the Commission made the check over the transposition of all the directives. What I'm saying is that there could have been moves by the national supervisors which were not prevented by the directive. They were not even guided, okay, but they were not prevented, which the national supervisors could have taken. The reason why there was not a precise guidance is exactly because there were different situations in different countries, and therefore subsidiarity applied, and depending on the economic and banking situation in a given country, the response would have been different than in another country.
So is it fair to say that the 2006 Capital Requirements Directive was sufficient, but that the national authorities then...
It's fair to say that the 2006 Capital Requirement Directives implementing Basel... the 2006 Capital Requirement Directive implementing Basel I was in that spirit of that time, which was the spirit of going mainly for principle basis. It's not fair to say that we didn't realize that it was not enough, and that's I've argued before to a question of Deputy O'Donnell, which was that indeed Basel II then was essentially scrapped and Basel III came. So, as I said, it is an history of evolution where there has been a constant improvement of the regulation and the supervision by learning from the places where crisis emerged.
And just the final question, because it was something you mentioned earlier about credit concentration limits. Are we going to have harmonisation at the EU level on credit concentration limits, or will that be left to national authorities in the new supervisory structures?
Sorry,
credit concentration limits.
Yes?
I wasn't clear from your earlier statement if there was going to be an EU-wide directive on credit concentration as part of new structures, or is that going to be left again to the national authorities?
Credit concentration is certainly part of the capital requirement directives. And credit concentration, you may look at it in different ways, moving, let's say, from micro to macro. The most obvious mechanism of credit concentration is excessive concentration to a counterparty. A bank lends to me too much, or a bank lends to a particular company too much. Then you have credit concentration to a sector. A bank lends too much to the sector of doing whatever you want. And then there is credit concentration to a region. A bank lends too much to activities exposed toward that region or to that region. When you do this movement, you do a movement which is from micro to macro. And one of the things I've said, and this is, I think, one of the learning that we have from the crisis, is that national supervisors necessarily were more on a micro level. And not for nothing, among the institutions that were created in 2011, there was the European Supervisory Risk Board, and the European Supervisory Risk Board has exactly the task to help countries to do macroprudential supervision and to do macroprudential supervision in the context of the single market. So definitely credit concentration is an issue, but what I'm trying to say is that this issue has both micro and macro aspects. So this issue can both be tackled at the level of one single counterparty by one single supervisor, or can be tackled at higher level, can necessitate some coordinations of the measures.
But the responsibility is, sorry, I wasn't clear on the answer. The responsibility lies with the national supervisor for identifying those risks.
The responsibility lies, now that we have this system of single supervision, the ECB, responsible for the 120 largest banks in Europe, will be able to identify for those banks if there are risks of credit concentrations.